Good afternoon, everyone. I'm Stacy Halber from the Federal Reserve Bank of Minneapolis, and I'd like to welcome you to today's installment of Conversations with the Fed. This afternoon, we'll be hearing from Christine Gaffney, Senior Vice President of our Supervision, Regulation, and Credit Division. Christine will be presenting on the Paycheck Protection Program Liquidity Facility. Also joining us later in the program is Melodie Carlson, Chief Operations Officer of Sunrise Banks, who will be talking with Christine about her experience with the program specifically. Before I hand things over to Christine, however, just a few notes for our audience today. We will set aside some time at the end of the session for audience questions. So please feel free to type any questions that you have throughout in the chat box, and we will address as many of those as we can at the end of today's session based on what time will allow. Also, after today's session, when we wrap up, you will be presented with a brief summary, and we ask that you take a moment to please provide us some feedback. So with that said, I'll hand it off to Christine, who will get us started.
Great. Thank you for that, Stacy, and welcome everybody. Thank you for joining us today. As Stacy noted, we're going to cover the Paycheck Protection Program Liquidity Facility today. More specifically, we're going to get into how the Fed helped American workers in a time of crisis. So before we get into that, I'd like to level set just a bit and provide a disclaimer that the views here expressed here are mine only, not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. We always have to get that out of the way first to keep our friends in the legal department happy. So with that, let's go ahead and jump into today's agenda. This is what we're going to cover today. And again, a little bit of a high level. I think all of you have heard of the Paycheck Protection Program, or the PPP, and that's run by the Small Business Administration. But what we're going to cover today is the Fed's role in supporting that PPP through our liquidity facility, as we just said, the PPPLF, or 3PLF, because it's a bit of a mouthful to say. So I'm going to provide maybe a bit of information about what the Fed does for emergency lending, the overview of the program, the timeline, and the impact. And then my favorite part that I'm looking forward to is the banker's perspective. And we'll have a bit of a chat with Melodie Carlson with Sunrise Banks at that time. And of course, as Stacy noted, feel free to submit questions in the chat box, and folks will be keeping an eye on that, and we'll be happy to answer all the questions that we can. So let's jump in and start by discussing the Federal Reserve lending under normal circumstances. So this is our credit facilities that we operate on a day-to-day basis. And just to give you an idea of this, the Federal Reserve is a bank for banks. So just like you or I use a bank to store our savings, obtain loans, commercial banks do that with us. They store their savings with us and they obtain loans at the Fed. We call this the discount window program, and there's set statutory criteria in which we can lend to them. So you can see here some overnight terms that we use. Sometimes it's seasonal credit. I think the best way to try explain what we do here is just to give you a couple examples. So why would a bank need a loan? So similar to you or I, you might have a house renovation, you might need an IT upgrade, things along those lines. But really the main reason that a bank might need a loan from us is actually its own loan growth. So to think about this, think about springtime. That's very common house shopping season. People are in the market, they're looking to purchase homes. And if you've got a lot of that activity and a bank is giving out all of this money by way of loans, they might not have enough capital in their reserves to fund all of that. So they might come to us to get a loan to try stretch the time before you start making payments on your loan. Or another example that really is strong for our area of the country that we serve in Minneapolis is for our farming communities. So this is what we call seasonal credit. For our farming communities right now, everybody's out in the field, spring planting, then comes fertilizer in the summer, and those farmers don't get paid until harvest time. And so banks might need a loan to bridge that timing before the farmer can repay its loan. So that's another example of why a bank might come to us for a loan. Very similar to what you might do when you go to a bank pledges loans from their books to us as collateral, and we hold that. And that's the security that we get so that we know that they will repay us. And if for some reason they don't, then we've got that loan and we're fully repaid in that way. So each of the 12 reserve banks around the country manages their own process for administering these loans for their relevant district of the Federal Reserve. Now, however, during emergencies, the Federal Reserve Board, and when I say that, I mean the Board of Governors out in Washington, D.C., they might authorize the reserve banks to extend credit more broadly than usual. So something outside of these normal get a bank through a liquidity time of need. So to do that, let's go ahead and take a look at the Emergency Lending Authority under the Federal Reserve Act, and that's called Section 13.3. And it sounds like it's big and fancy, but it literally is Section 13.3 of the Act. And so we just call it that, 13.3. The key takeaway here is that under this act, during unusual and exigent circumstances, the Board of Governors can authorize reserve banks to extend credit to a broader range of borrowers. And that includes non-depository institutions as well. So not just the banks that can come in on a normal basis. A couple of huge takeaways here. The program does require prior approval from the Secretary of the Treasury. So at the time that we were getting this facility set up, that was Treasury Secretary Mnuchin. Of course, now under the Biden administration, that is Treasury Secretary Yellen. And you can see here, there's a little bit of criteria in that we've got to have broad-based eligibility for a program in order for it to be authorized. And we also need to make sure that we've got appropriate security to protect taxpayers from loss, which I would imagine is appealing to most of you that are watching to know that we do pay close attention to that. Over the years, the Fed has invoked 13.3 in various ways to stabilize the financial markets. Just a couple of examples. Back in the 1930s and the Great Depression, the 13.3 was invoked then to stabilize the markets. Also very much so, very strongly used in 2007 through 2009 during that financial crisis. And then, of course, now in response to the COVID-19 pandemic. A few examples here that you probably have heard of the 13.3 facilities that we're using now. There's the Main Street Lending Program, which is run out of the Federal Reserve Bank of Boston. There's also the municipal liquidity facility, and there's many more that we have listed in an appendix that will be available to you in this presentation on our public website after the event today. And then, of course, the one that's most near and dear to our heart is the 3PLF program, and that is where we're going to focus today. So this is a little bit about what this is. I think if you take away anything today, the purpose of the 3PLF is really to bolster the effectiveness of the SBA's Paycheck Protection Program. So as many of you know, or many of you have maybe been recipients of the PPP, lenders are making loans to small businesses for payroll related or other certain purposes specified in the CARES Act. That's what authorized all of the money. And then the SBA guarantees those PPP loans. And then in return, we give the liquidity to the financial institutions, or we'll talk a bit more in just shortly about also non-depository institutions using those PPP loans as collateral. Minneapolis, here in what we call the 9th District, we're the program lead for this facility across all 12 reserve banks and for the Board of Governors. So to do that, we coordinate and set consistent processes, administer the program, like I said, on behalf of the whole Federal Reserve System, but transactions are processed by all 12 reserve banks. So imagine trying to keep all these 12 arms all together under our oversight to make sure that we're being consistent and meeting all compliance requirements. I should note that when we talk about the PPP loans, for us, we're not interested, well, we are interested, but we do not enforce the rules. We are not granting forgiveness. all of those types of questions about eligibility, how can you use the funds, all of that falls under the SBA. So if you've got questions in that space, unfortunately, I'm not your girl to answer that, but we can certainly get you the resources you need if you do have questions in that space. And again, the 3PLF eligibility here is broad-based. And from the last slide, we saw that that's a critical element for 13.3 Emergency Lending Authority. And you can see here, anybody that is eligible to originate loans to small businesses may access funding through the PPPLF. So again, that's both depository institutions, which are familiar to all of you, and then non-depository institutions. I thought it might be helpful to give you a couple examples. What do I mean when I say non-depository? Of course, here we're very familiar with farming. So Farm Credit Services, that's a non-depository institution. A fintech firm, there's a wide variety of those. Small business lending companies, or even community development financial institutions. They don't hold public deposits. So under this program, all of them can come to us in order to originate these PPP loans. And then another element of this that was important to policymakers is that it's not just lenders that can pledge the loans that they originate. They can also purchase them from non-DIs or DIs, and either of them can pledge those purchased loans to us. So in some cases, we've got entities that might have done a big push to originate all these PPP loans that they could, get money out the door, help Main Street, but they might not have had the structure to process and service all of those when it was done. So then they sell them to another bank that might be better positioned to service those loans. So let's walk through a diagram of how this process works. I'm a very visual person, so I thought this might be helpful for some of you that are in that same boat here. So if you look at this picture here, you can see on the far left of your screen, your small business customer is going to their lender, whether it's a bank or a non-bank, to obtain that PPP loan. And then to initiate that 3PLF extension of credit, that lender is pledging that very PPP loan to us at the Federal Reserve Bank. It's unfortunate that we're in the current environment that we are, because normally we do these sessions in the bank, but at least at a minimum, you can see a picture of our beautiful building. And so in turn, you can see on the bottom, if you look at the Fed there, we're taking that PPPLF extension of credit and then giving that to the lender so that they've got money to fund that loan. And so that's really what we are talking about here, is that banks were trying really hard to fund all of the needs, but nobody's got all that capital on hand. It's a lot of money going out the door, and we will talk about that a bit as well. But as you can see here, it goes from the small business to the lender to us. We issue the lender that loan, and then the lender in turn does the issuing on the back end back to the small business. And then just a couple of details on what that looks like. For us, very straightforward. Whatever the terms of your PPP loan are, so your dollar amount and then the maturity, which is set at 5 years. Early in the program, it was 2 years, but the collateral for us, the PPPLF advance, exactly matches that PPP loan. So if your loan was for $30,000 for 5 years, that is exactly what we give the lender in order to fund it. That's part of our criteria in what is called the term sheet, is that it has to match exactly. And then the interest rate that we charge the lender for giving them this funding is a fixed rate of 35 basis points. And then through obtaining this PPPLF loan, like I've said, the lender now has all the funds that it needs to pay off to pay the borrower until the loan is either paid off by the small business or forgiven by the SBA. And the rules also state that whenever the small business pays off the loan and or it's forgiven, the lender in turn has to pay us. So let's talk a little bit about, now that we know how this works, the timeline of how quickly this emergency facility was implemented and how the program has evolved. A lot of words on this slide. I think one of the most important things here is to focus on those arrows. where you can see the funding. I never really imagined in my career that I'd be talking so frequently in terms of billions of dollars, let alone millions, but there's a lot of money going on here. And so I mentioned the CARES Act a little bit earlier. You can see that with the advent of the CARES Act, $349 billion available to small businesses through the PPP program. And so, like we were just talking about, where are lenders going to get all of that money? And so that is exactly why policymakers here at the Federal Reserve Board out in Washington, D.C., created the facility in partnership with the Treasury. We moved fast. So let me just give you a little bit of a background here. This was a day in the life at the time, almost a year ago. You can see in the timing here, we're coming up on 1 year of the facility being announced. But we were operationalized within 7 business days after announcement. So anybody can say what you'd like about the government not moving fast. We debunked that myth in getting this up and running. We really worked around the clock, averaging about 15-hour workdays, including weekends. And actually last year that included Easter on April 12th. These dates really are ingrained in our minds. And the story with this is that one of my colleagues, Vice President Amy Kaitonen, got an email the evening of Saturday, April 4th. And she reached out to me and said that, hey, we got a request for a meeting early Sunday, April 5th, the next day. I don't know if you saw it or not. And so we jumped on that call Sunday, April 5th, and chaos ensued. We had emergency meetings all through the weekend. The meetings included the Federal Reserve Board of Governors, our partnering reserve banks, our IT teams, all appropriate stakeholders. And it really felt like we hardly slept. I guess on the bright side, we were in the middle of a pandemic, everything was shut down and we had nowhere to go anyway and nothing else to do. So I guess that worked in our favor. The IT solution for this was deployed at 2:40 a.m. on Thursday, April 16th. We were up and ready for business when banks opened that very next morning. Actually, it was the same day because it was past midnight. And the very first PPPLF loan was made that afternoon. And I'm very proud to say it was done by my team in Minneapolis. So it was very important to us that we get these funds out the door to help Main Street and help these financial institutions make these PPP loans. As you could imagine, the operational readiness had many, many facets. We had to do Board of Governor press releases. We did blast emails to over 10,000 of our borrowers that already existed using that discount window that I explained earlier. We did several, what we call Ask the Fed training sessions. We had over 11,000 attendees. We often were, sort of like last minute trying to get things out the door. We got very familiar in these training sessions with seeing people's children run across the background or dogs barking, all of those types of things. But it was reality. Everybody was working at home. And as you can see, I still am. That's still the way of our world. And then we also did a lot of calls with The Hill, the Independent Community Bankers Association, the American Bankers Association, pretty much named the industry group, and we were talking to them. Then you can see that there was that money went quick, and most of you probably, or many of you probably experienced that. Another $310 billion in funding was authorized. And we also expanded the program to include the non-depository institutions that I spoke about earlier. It was much easier for us to get the DIs on board, depository institutions, because they already borrowed from us. We already had a way to lend to them, but we did have a week of time that went by before we could get the non-depository institutions onboarded as well. And then you can see also on the bottom arrow there, around Christmas time last year, another $248 billion in PPP funding was approved. And I had mentioned earlier that it seems strange to speak in terms of billions. We had already been, close to the 700 mark. And so when this came around, we were saying, oh, it's only 248 billion this time. And we were, at that time, it was announced, it was passed on the Hill right before Christmas. And I can tell you, I was sitting at my parents' home and I literally said, there goes Christmas, I'm going to have to work. Right, wrong, or otherwise, President Trump did not sign the bill until after Christmas. So nonetheless, the holidays were saved, and we've still got more funding that's available, and we've still been working off of this funding. And then most recently, the Hill did pass the PPP program. So this is, again, the one separate through the SBA. That deadline to apply for loans has been extended to May 31st. And we being the Federal Reserve Board, our policymakers extended our program as well. So we're going until the end of June right now, which lines up with the PPP program quite well. And we're continuing to keep an eye on the evolving needs of the economy, and we respond to support new legislation. And so as long as the 13.3 circumstances exist, we'll continue to evaluate the need to keep the 3PLF facility up and running. Next, I'd like to show you a little bit about the numbers here. And so this gives you a really good visual about the substantial participation that we've had in the 3PLF. So these numbers are again listed in billions of dollars that flowed out through lenders to small businesses. If you look at that greenish sort of turquoise line, that's the total amount of 3PLF loan balances outstanding. So that means that's what banks or non-banks have borrowed from us that they have not yet paid back. So if you look at the end of February, we have about 53.1 billion outstanding that we have given out to DIs and non-DIs that they have not yet paid back to us. And then you can see the spike at the beginning of the program really illustrates how important and critical this emergency funding was. We really hit some peaks early on. And you also can see all of this data is publicly available. That will be, links to that will be in the appendix on the slide deck that you will receive again at the conclusion of this event. But you can also see that as of the end of February, we've extended over $118 billion to participants over the course of the program. So that really shows you that there was a need by our DIs and non-DIs. So this slide here shows you where we are focusing. Financial markets have stabilized significantly. The availability of credit for small businesses served by the PPP remains limited. We're getting down there in funds. We meet with the SBA every Friday at 8 a.m. Central and get an update on where things stand. We do have a lot of continued uncertainty here. We're not quite sure what might go on at the Hill. We have professionals that keep an eye on potential legislation and any changes to the process that might affect us. That notwithstanding, we have to continue making our advances, and we also have to continue processing the pay downs. We're starting to see a lot more forgiveness payments flow in that are working on these, doing that until either the money runs out or everything is paid off. And then we report to Congress every single month on our data volumes. And that's what I was letting you know, that you will be able to have access to that via the links in the appendix. So hopefully that gives you sufficient understanding of the facility and the Fed's role. And now we're going to get to our discussion with Melodie Carlson for a banker's perspective of the program. So let me first introduce her in a bit more detail. Melodie, as Stacy mentioned, serves as the Chief Operating Officer at Sunrise Banks. Sunrise Banks is a local lender here in the Twin Cities. Melodie has over 20 years of experience in accounting, auditing, compliance, finance, and operations. She runs the whole gamut, which explains her title. And she began her career at Larson Allen. She spent 14 years at Target and then joined Sunrise as its COO in 2015. And Melodie also is a graduate of the University of St. Thomas, for any of you that are alumni out there. I'd like to start by asking you, Melodie, a bit about this quote by your CEO here, Mr. Reiling. I think this is absolutely remarkable. And he calls this opportunity, he calls what we're going through here an opportunity that represents a bigger than us moment, and being called to serve our country to get these funds out the door. Can you talk a little bit about how he relayed this quote to you and the rest of the team, and how your lenders on the front line really felt about this?
Absolutely. Well, first of all, thanks for having me. I'm happy to be virtually here with everybody. David Reiling, for those that have met him, he is really good at inspiring all of the employees at Sunrise. Our total employee base is about 275, and we were involved in this program early on, right away at the beginning. And so there was a lot of discussions at the executive level, along with various employee meetings, to basically say it's our time to stand up and help out our communities around us. And we're a very focused community bank here in the Twin Cities. And so it just felt natural. We're one of the larger SBA lenders in Minnesota. We work with a lot of small businesses already. And so it just felt very comfortable and pretty day-to-day thing we're going to do. We're going to step up and do this. And part of the quote talks about bigger than us. And that's one of our values. It's our core values at the bank. So we hire, fire, promote, reward people on values like that. And really it's, are we going to step up and we need to do this? And so it was pretty seamless, similar to what you talked about from the Fed side of the view. When the banker's side, it was one of those, as soon as we started hearing the news about this passing, we quickly started figuring out what are the details needed. And at the time when we started this a year ago, it was quite manual, to be honest with you, while we all started figuring this out. And then we started, working towards automated solutions where we could. And we work a lot with small businesses. So we had a lot of our customers asking us right away, are you going to be involved? And so it was just a really natural way for us to get involved.
That's great. And it's helpful to know that that was one of your core values, which makes this seem like a very natural fit. Right. And stepping up to do whatever is needed in our country's time of need, particularly on Main Street. Can you talk a little bit to us, Melodie, about how quickly you got the money out the door to your customers, and maybe what kind of businesses Sunrise Banks was able to support?
Absolutely. So we really were one of the first, obviously not probably the first. I think a lot of the bigger banks were able to get up and running quite fast, but we were definitely within the first couple of weeks submitting applications to the SBA. As you might remember, there was some troubles at first where we were all locking up trying to submit that, but eventually everything cleared up. And, when I look back at what we called round one, which was kind of all of last year in this process, we were able to fund over 2,000 or almost 2,000 loans that first 9-month program. And, really, when I think back on that and when we talk about the statistics, as with many small business, supported banks, a lot of our loans were small. I mean, when we say almost 2,000 loans, those aren't millions of dollars each. Some of them, of course, are, but most of them were under 50,000. The majority of our loans were. And I mean, often, I remember last year seeing loans that we spent a lot of time on and they ended up being $700 loans. But to that business owner, they were so appreciative. Some of the things, obviously I won't give customer names, but we had quite a few stories and examples where lenders, of course, but even people like me who aren't normally meeting with the customers directly as often, I'm often in the back room doing all my work. We had pretty much an all hands on deck. I mean, when I look at the number of our employees that have touched this program, it's pretty much everybody in the bank. We have people working on the back end that no one will know about, right? But they're doing all kinds of work to try and move this through. So when it started out manual, we just project managed it. And we had stages we went through from beginning to end to get to the SBA lender approval process. And we kind of just made it a process. We've got a lot of project management type experience at the bank. That really helped us because at first you're figuring out as you go. And then we did work with a third-party provider that helped us automate parts of it. So our application eventually became pretty seamless to the customer. They did as much as they could online, and then we just would go back and forth over emails or phone calls as needed to keep it moving. When we look at this year, kind of as you said, we were all kind of like, please don't pass it at Christmas. We were thankful that at least it was early January that we could all get really busy again. And again, I guess when you're in a pandemic and I'm working from my house too, in some ways, I'd rather it be this time of when you're at home and not as much going on. But yeah, we jumped up again right away. We were one of the first to submit applications again in January. I don't see all the stats every day on externally, but we're again, I think one of the top PPP loan providers in Minnesota, especially for our size. And so we already have submitted over 1,000 loans this year to date, which again, if this continues, we'll see what happens when the money runs out or if they extend dollars or give more. But it's been an amazing program. I just have to say, I think so often people hear this, and I know bankers on the call understand, but we feel the best about the ones that are for the one-person employee shops that are struggling to make ends meet. And knowing that loan is $20,000 may not mean much to us and what fees we'll get, but I mean, I've teared up seeing some of the stories we see about people just breaking down when they find out they get the loan, because it really matters to them and it's helping them function. And we have seen, especially now that it's been a year, some of our small businesses, when they're submitting their 2020 year-end financials, we can see the impact that if they wouldn't have received one or two draws of loans, they wouldn't have made it. So.
Yeah, thank you for that, Melodie. And I think we can completely relate on the Fed side about being maybe a little bit surprised at some of the dollar amounts that we see. I think I haven't checked in a while, but at one point, our lowest dollar amount loan that was pledged to us was $400. And that's something to somebody. And for us, it doesn't matter what the dollar amount is, as long as it's making a difference. It's keeping somebody employed. It's keeping a business open. And then similarly, we also went all hands on deck. When I talked through the numbers, 118 billion out the door, we did that across the Federal Reserve System without adding any staffing. So talk about all hands on deck. We pulled anybody that might have had an ounce of white space in his or her day and said, hey, come on, we got something for you to do over here.
Right.
And people really rose to the occasion because they recognize that we are doing a duty for the country by serving the American people, which I think was really, really neat. Can you talk next with us a little bit, Melodie, about how how Sunrise used the facility, maybe in different phases of the crisis? Did you have a planned approach there, or was it sort of all in? Talk a little bit about that for us, please.
Sure. So for us as a bank, we're a little unique. For those that don't know, we have two main business. Obviously, we're a community bank and we do the typical lending and deposit pieces, but then we also have a national products presence. So why I bring that up is we're one of the larger prepaid card issuers in the country, actually, which I didn't even know until I started looking at Sunrise to work here years ago. And so I say that because we really have a lot of liquidity because of those deposits from the prepaid cards. So we didn't need the PPPLF really for the liquidity piece. We really needed it for the capital component of it, because we needed to make sure we, of course, kept our, OCC mandated tier 1 leverage ratios and everything in place. And so for us, when we first heard about all of that, it was a little bit of working with, our CFO. We were talking through, okay, we don't need that for liquidity, but we don't want to worry about not meeting our ratios when we need to from the regulator standpoint and everything we should for safety and soundness. So we did use it throughout, as you mentioned. I mean, I think submit a collateral file of all the loans every 2 weeks as requested. And that has been helpful for us, just because when you have a lot of the loans coming in and going off all the time and they're getting forgiven or they're paying them off, you really just need the ability to have that facility there so that we're not having to worry about not meeting our ratios for capital purposes. At first, I'll admit it, the rate on the loan is low, as we all know, and then you're paying 35 basis points for the liquidity fund. But really, where we're making any money is the fees. And so we just looked at that, like that's the way that we need to do this. And yes, you end up making some money on the fees, but as we said, some of the amounts are low. And so we were just appreciative of having this option, because we would have probably had to stop our program for PPP if we couldn't keep our ratios intact without this.
Yeah, and you mentioned something, Melodie, that is kind of behind the scenes for us, is the every 2 week reporting. So to give folks listening a little idea, is that all of the institutions that participate in the 3PLF program, they're required to report to us every 2 weeks on loans that are paid, forgiven. So just to give you an idea of the work that goes in on the back end, the operational aspects, is that for all the work that Melodie's bank has to do, we've got somebody that's processing all of that at the same time. What would you say, Melodie, do you have for your type of customers was there a concentration in businesses that you were able to support, or was it a little bit all over the board in terms of whether it was hospitality or, movie theaters, restaurants, that type of thing?
Yeah, great question. There was definitely across the board. It's interesting for us because, again, we're a national bank, of course, and like I said, we do national products, but a lot of our loans are basically in Minnesota. And so other than small dollar loans, but as far as collateral loans. And what was interesting for us is once we started we opened the doors right away to say even new customers could apply. I guess I'm hearing that a lot of banks didn't do that, especially now, and some of them did. And so interesting stat is that we actually have at least one loan in 49 of the 50 states for PPP, which we had a little map on a grid that at first was kind of fun to watch. And after a while, it was like, wow, this really is going to go all across the country. And a lot of it's just from online and search options. And so when I look at across the industries, I mean, we have our existing customer base, we do have a lot of small businesses, whether it's in, retail or restaurants and real estate and things like that. But we have seen across the board. I mean, the NAICS codes you use, and you start to see all the different industries and what kind of businesses they are. I don't have the exact stat, but I would have to say the vast majority of our loans, I mean, a lot of them are under 10 employees. I mean, David Reiling, our CEO, has quoted, often it's 1 to 3 employee businesses that are kind of just making it to get through this process in this pandemic with the PPP loan. But we've seen kind of across the gamut on industries. I would say that, we do see a lot though in the hospitality, the retail, where we're appreciative as the bank and helping a community that they offer the higher loan amount for those specific industries as well, because they've been hardest hit.
Yeah, can you talk a little bit about whether you experienced, I would imagine that you did. I hear this often about, well, I just have a small operation, or I don't want to try to figure out the forgiveness rules. I don't want to bother with trying to get a PPP loan. Did you hear that a lot in the response, perhaps when your customers came in? I'm guessing or hoping they said, oh, that was way easier than I thought it was going to be.
Yeah, absolutely. So I will say last year we had people that, especially at first when everything's pretty manual at first, and then we're submitting to them like, sorry, the calculation we came up with is lower than what you applied for. And so often that was kind of the tough discussion too. And then they would often say, well, I don't even want to go through this then because I don't want to deal with the work on the forgiveness side. And we didn't even, none of us knew yet what that was going to look like because the forms weren't even released yet by the SBA at that time. And so a lot of it was, we'll help you along the way. That's our job, right? So we did get a lot of people that, still took our word and went with a lower amount and got the loan. But we also had some that did literally withdraw and say, I don't want to. And then interestingly, once all of the forgiveness rules and application process and everything was released, and we even had summits, I think similar to this for all of our PPP customers last year to kind of help them understand it as far as calculations and what this will look like. And now we're finding this year that some people that never got a loan last year came back and said, okay, can I get one now? Because they understand it's simpler. So we've had a lot of actually draw one, as we call it, or first round, loans now. And then they're asking, can I get another one still now that they extended? So we're explaining all of that. And then really to your point, a lot of what we've done is we try to simplify it. And as you know, with the SBA, anything under $150,000 loans are very simple for forgiveness. And we're thankful from the bank side too, because and I'm sure you are too, it's a lot simpler. So we've actually worked to automate as much as we can with our customers to help with that. So obviously the larger dollar amounts are more work because there's more documentation and proof, but the small dollar ones are really simple. And we've already, I believe our latest stat is we've already forgiven $80 million of our portfolio to date between last year and now. And to give context, I mean, that's probably a third of all of the dollars. And so we see it really just throughout the year, it's just going to keep evolving where we're going to be able to forgive more and more. And I think the SBA is getting more efficient and able to do this as well. And so I really think that I expected it to be more work than it's actually turning out to be on the forgiveness side.
Yeah, we have a similar feeling on our side. Even though we've got collateral, we're fully secure. We were also big fans of the simplified forgiveness process because it just makes it easier for everyone. And the idea of these businesses perhaps not getting forgiveness based on a technicality just didn't seem right. And so it does make things a lot easier, I think, across the board. So Melodie, I wanted to ask you a little bit about, some folks on my team did some great research and they found this blog post from Sunrise that explains the symbiotic relationship between central banks and commercial banks. And I'm wondering if you could maybe express in your own words what that partnership means for American businesses and consumers.
Yeah, absolutely. It's interesting that the timing of when our article even came out and then when you had asked about talking today. But, yes, I mean, obviously we have sometimes had to borrow from the Federal Reserve. And so that is an option. And really, we are an SBA lender, as I mentioned earlier. And so there's a lot of back and forth, I think, and good relationships there with the Federal Reserve. And, I like having some people we can reach out to if we have specific questions as well. And so, I think what's nice about the blog posts like that is if you're not in banking, especially, I don't think a lot of the consumers and community members understand some of that. And they might think that doesn't make, well, how does a bank do that? And so I think a lot of it too is just helping maybe the community understand how it works, because before this, unless you were a small business owner, did anyone even necessarily know what the SBA did and what did the Federal Reserve do? And so some of it's also just helping people understand a little more about how the process works, because all of this now is front and center. Everyone knows what that is now, but didn't a year ago.
Yeah, that's helpful. Thank you. And then I wanted to ask a little bit about, now we're in this period of increased vaccinations. Schools and businesses are opening up. I know that has been the case more for some of the other states in the 9th district as opposed to Minnesota, but we're getting there now.
Right.
And there's a sense that we've now maybe entered the next phase of the crisis. And so I'm wondering if you could talk a little bit about how these different dynamics factor into Sunrise's preparations for what's ahead. I mean, even including, that you talked about first draw, second draw, people wanting to come back in, and the funds are starting to dwindle down there. And I'm wondering how you all are thinking about that.
Yeah, great question. I'll try and answer them all. Just remind me if I forget any. So I think first, a couple things. Yes, so we're based primarily in Minnesota. We do have an office in Sioux Falls, so there is the South Dakota piece. And then we do have about 5 employees that work remote permanently outside of Minnesota. And so we've had to kind of watch closely on all the different states we're involved with. Specifically for Minnesota, our headquarters, for those that don't know, is right on the border of Minneapolis and St. Paul. And we normally have well over 100 people there. And we were, again, pretty early on, our CEO, David Reiling, just said, we're just not going to wait and hear what we have to do. We're just going to move everyone home that we can. So back on mid-March, we moved as many people as possible home. So I'm one of them. And so really outside of our branches, we only have a very, shell group that need to be in the office. Mainly IT and a few people that come in and out to work on a couple tasks that are just too hard to do at home. And we've been that way the whole time. We keep extending our date. We call it return to office, and we keep thinking it's going to happen. And as you mentioned, things have been a little slower than planned. So currently we say mid-June. We'll see. I'm not putting a whole lot of hope yet, but I'm feeling better now that the vaccine is really rolling out faster this year than it was earlier. So, how we're looking at it from an employee standpoint is safety first, and we're just kind of making it a need to come in unless they really have to. We're trying to keep them at home. At our branches, of course, we're banks. We have to be open, but we are doing appointment only as much as possible in our lobbies. And then, of course, we have walk-ups and drive-ups. And so we're just trying to keep everyone up to date in our employee base. And then obviously with our communities, we were contemplating, should we keep the branches fully opened? And one of the things we said was, even if they want us to be fully open, it's better for everybody if we limit how many people are in our lobbies. So we've been doing that for many, many months, so pretty much the whole time. I think as far as what you said too, it's interesting dynamic, right? We've got the vaccines coming. There's an uptick, at least in Minnesota, of more cases again. There's the variants. It's one of those where I have so much hope, and then every so often it's like 2 steps back, and I feel like I'm pulled back into when is this going to be over? And so we have to do a lot of that discussions, even as a leader and employee too. But I think we're getting closer. I think that this PPP program extension is great. I am seeing the news out there, like you said, about, oh gosh, when is it going to run out? We are starting to talk about that because we still have people applying every day. Not as many now as obviously January, but we're continuing to work through any exceptions that we're finding to get them through. And so I don't know what the tea leaves say on if they're going to add more money or not. We'll see. But I'm a little concerned because there are still many small businesses out there that still need money and haven't yet received the draw too. I see a lot of the back end with the SBA portal. There's a lot of errors that we're struggling to ourselves figure out, and how can our customers do that? So we're doing an awful lot of back and forth. The tough ones are what's left in a lot of cases. And so I'm hopeful that they'll maybe allocate some more money to figure out a way to get these last loans through, or maybe they'll do a round 3. I don't know, but I don't think we're done yet. I'm hoping we're getting closer, and we're feeling a lot better. We can tell some of our businesses around here even are doing better now, and at least they're open, but there's still a number of them that have closed, and I don't know if they'll reopen without some of this money.
Yeah, you touched a little bit on what I wanted to ask you next, and then I think we'll check to see if we've got any questions in the Q&A. But talking about some businesses that have still been able to stay open, some that have closed that you don't know if they're going to reopen. I happen to have, we're all in the same boat as you with largely working at home. Like, we don't have a branch office locations like you do, but we do have to handle cash, and we've got to have law enforcement, and so we do have to have people on site. And so it was my turn as a member of the management committee last Friday. And even downtown, there are still some of my favorite restaurants still are boarded up and not open. And so I just wanted to ask a little bit about, whether it's personal experiences without disclosing customers, of course, about stabilizing the community outside of just the PPP loans. If you're seeing maybe some ripple effects in that space.
Yeah, a year ago, we felt a little bit like the sky was falling, right? Because we're all worried as a bank about how are our charge-offs going to go? What are our reserves going to look like? Rates, interest rates were going down. I mean, everything was kind of piling up right around the same time as PPP was coming out. And so I remember us thinking, how much are we going to have to add to our reserves? How is this going to look? How a year from now, back then, how many businesses are we going to have to take over, right? As far as the real estate and the loans. Thankfully, I think because of all of these programs, we aren't seeing as much as we thought. I mean, of course, we're seeing, an uptick, but it feels like, and even talking to other, community banks and others around, I think we're cautiously optimistic that I don't think it's going to be nearly as bad as it could have been, or we thought it could have been a year ago. Customers and non-customers, we're hearing and seeing businesses that have temporarily closed, and we're all reading in the news, right? Some of them are selling and just staying closed. But I am also hearing some good stories of people are starting to open them up too, that haven't, they still have a lease or they own the building. I'm starting to see hours extended. I'm starting to see more hope that way. From our customer standpoint, we're seeing some that are actually above break even at this point, where a year ago they did, obviously first and second quarter and the first quarter did not look good. So we are seeing a lot of improvements that way, but cautiously optimistic. We're hopeful that it's just going to go up from here.
I can appreciate the cautious optimism because, of course, aside from the 3PLF, my day job is supervising financial institutions. So
right.
we like to see those low charge-offs and the flush liquidity and no credit concerns as well. So I see Stacy is joining us here to go to some Q&A. So Stacy, let me just check in with you to see what we might have there.
Sure, we do have a couple questions here. So if we could take maybe a step back, kind of related to your presentation originally, Christine. You had touched on it briefly, but just for some clarification purposes, you had mentioned that the non-depository institutions like fintech firms and such could obtain through the PPPLF from the Fed. Could they also, were they eligible for similar loans before that, or was it just through the 13.3 emergency lending function?
That's a good question, and thank you to the person that submitted that. No, non-DIs, so fintech firms, farm credit, any of those entities, they cannot borrow from the Fed under normal circumstances through the discount window. That is just unusual exigent circumstances under 13.3. And that's why I had mentioned that we were up and running within 1 week for our depository institutions. It took us a little bit longer to figure out how do we get these non-DIs in the door. How do we get, they just don't have the same mechanisms because they don't have the same relationship with us. So we call it the rails. So our automated computer systems, DIs were familiar with that. Non-DIs had never used it. And so that's what took us a little bit more time. But once the liquidity facility is closed, right now that's set for the end of June, then those non-DIs will not have access to our facility any longer under any circumstances.
Sure, great. And then jumping forward a little bit, I know that Melodie had talked a little bit about some of her customers whose loans were forgiven and kind of a general percentage of that. Do we have any idea what the overall percentage is? Christine, do you get reporting as such overall across the board? How much is, or what percentage is forgiven?
So that really is a question for the SBA. And if you went out to the SBA's website, I'm guessing they've got data published on that. I know going into the program, I'm trying to be careful here because I certainly can't speak for the SBA and we work in close partnership with them. So I would never want to make them angry. But I know that they were planning going in that, as long as you follow the rules, there's no reason that your loan should not be forgiven. And by rules, it's things like use it for payroll related expenses. And then of course they expanded to be the simplified form for under 150,000. So going in, they were planning on, 95%-ish forgiveness rate. So again, I don't know what the exact numbers are. I mean, Melodie can speak to what they're experiencing at Sunrise, and perhaps that would be helpful. But otherwise, I would suggest going to the SBA's website, very detailed data that they publish routinely.
I would agree. I mean, when I said the percentage so far for us, a lot of it's based on when the customer wants to apply for forgiveness. And really, we just rolled out a lot of that earlier this year, and we were trying to wait until we had it more automated to help the customer. So I would agree. I'm not hearing anecdotally or from other banks either that they're having a lot of trouble with it. It's more getting everything they need from the customer and submitting it. And then it can take up to, I think, 30 days to hear back. It doesn't mean it will, but it's really just getting that process going. But they have such a long time to be able to decide when they want to go through the process as far as getting the paperwork ready. And sometimes they're waiting for their, documentation from their accountants and things like that. But we're not necessarily seeing issues with the forgiveness process. It's just working through it.
Okay, so is it possible for you to share a little bit more about who actually is paying for these forgiven loans or where that money's coming from?
Well, if you think back, Stacy, to the slide that I had showed on the different programs. So the very first one was the CARES Act, and then there was the Economic Disaster Relief. I'm going to get the full name wrong. But so these funds are appropriated by Congress. So Congress is authorizing the Treasury to spend these funds. And so in plain and simple terms, at the end of the day, it's taxpayer money. I mean, it's being appropriated from the Hill. The Fed is not paying for these. It's essentially coming through those, whatever the bill is that is passed by the Congress. That's the funding for it all. One thing that I think is unique, and hopefully this was clear, but for the 3PLF is that we weren't given the funds from the Treasury and said, now here you go, you've got this pot of money, go make these loans to DIs and non-DIs. We simply just take the collateral, and that's all the security that we need. And so no money has changed hands between the Fed and the Treasury for the 3PLF. That's not the case for the other facilities, but we're very unique in that way because these are guaranteed loans that are expected to be fully forgiven. So very unique operation.
The one thing I'll add to your point earlier, as I think about it too, it's taxpayer money that's really going here. And so while I believe the SBA looks at banks like us that have these loans, we're just supposed to do reasonable due diligence and do the best we can to make sure we get everything we need to and it looks legitimate. But I will say that because it's taxpayer money, especially, we are catching fraud before it goes to the SBA. And I think every bank should be doing that, and I'm sure they are. But I'm frankly shocked sometimes at the items we receive and they're not legitimate. And I'm not saying that's a large percentage by any means, but we as a bank can choose to make that loan ineligible if we can tell that it's not a legitimate documentation. So I do feel good knowing that I know all the banks are doing that, but I think we're never going to catch everything, and we know that. And the SBA this year has done a lot more validity checks, I guess you'd say, in their systems to also look for things. So I think between the two sides, we're catching quite a bit of the potential fraud so that our taxpayer dollars are being used, hopefully in the best use to help businesses and ultimately then those employees stay working and not be laid off.
Yeah, and I can, Stacey, if I can just jump in real quick. I did see that there was a follow-up that came in about if it's taxpayer dollar, why not forgive all of it? Because of what Melodie just said.
That's right.
There is fraud, and we don't want people applying for these loans for payroll, supposedly, and they're off on a trip to Jamaica. That's why it's not automatic. There's got to be some checks and balance in place.
That's right.
And then there was also a follow-up as well with regards to the DI non-DI situation. So the question is, when do you start to provide full-scale PPPLF to the non-DI? How many days or weeks on average later than the DIs?
We actually were able to offer access to the non-DIs 1 week later. So it wasn't, ideally we would have got them both up and running at the same time, but policymakers decided there's money that's got to get out the door to Main Street. And so they chose to make the decision not to wait for both at the same time. So DIs were on April 16th, first advance, and then 1 week later, we added the non-DIs. And I can tell you at that time, the non-DIs came in full force. They were ready to go. They had, of course, think of a fintech firm. They've got automated systems for everything that they do. They had been making a ton of PPP loans, and they were just waiting for us so that they could have the liquidity that they needed to keep making more. So it was exactly 1 week later, and there was a conversation with Chair Powell and then Treasury Secretary Mnuchin saying, like, how many days is it going to take for this? Like, can you do it on Tuesday? I'm like, can you give me 1 week? Just give my team 1 week and we will make it happen. And thankfully, I didn't have to go back on my word. We made it happen in 1 week's time.
And I will agree, though, often if we submit an application to the SBA, not often, but sometimes it'll come back saying, well, this person already has a PPP loan number. And it's often a fintech that got in faster. They're so automated, and we're automated for quite a bit of it. For us, a lot of it, we want all the due diligence up front, where I don't know sometimes if it's so automated, they don't catch all of it until after. But that's one of the things we've seen. We've seen a lot of fintechs that were able to get a lot of loans done very quickly once it opened up.
Okay, so one other item out here, Melodie, this is kind of related to what you were talking about a little bit more. When you said that it was necessary for you to use this for your ability to maintain ratios, can you explain a little bit more about what that means exactly?
Sure. So when I talk about the capital ratios, really it's a percentage of your capital and total assets. So when you're growing your balance sheet, these loan balances quickly, like we were and we have been over the last year, if we didn't have the ability to use this PPLF to help kind of reduce the way that we would show that on the balance sheet, we wouldn't have had enough capital to show that. We would have had to increase that or take out more loans ourselves to cover that. So at the end of the day, that really helped us for this short term, because again, most of these loans are going to be off our books in the next year. It gave us a way to make sure that we have the right ratio. So often you need to be anywhere from 5 to 10%. If we wouldn't have had that ability to use the PPPLF, we would have been lower than the maintained minimum ratio we would have had, and that would have been hard for us to continue doing this program. I don't know, Christine, if you want to add anything. That's how I would explain it, but.
Yeah, I think you explained it really well, Melodie. I think just as an overarching maybe framework for that is that banks have to follow a regulatory reporting schema. And the Federal Reserve, for the banks we supervise, we're looking at their capital ratios. They've got requirements to meet. Melodie has a different regulator, the Office of the Comptroller of Currency, or the OCC. Same thing. It's just a different regulator, but they're essentially meeting our requirements, and there are rules and regulations put in place to make sure that the bank can withstand, different credit crises or whatever it might be. So that's really what we're talking about there.
We just have one last item out here, which is about all we are probably going to have time for, but just again for some clarification. So the question is, how were businesses able to get loans fraudulently, yet the banks are supposed to verify expenses prior to providing the loans? For example, from Form 941 for payroll or leases to verify rent.
That's a good question. So yes, banks and fintechs should all be doing those steps. We require, for example, the same things you just mentioned. So if it's if they have employees, they need to form 941, which is the quarterly payroll tax forms. We want to see their tax returns. There's a variety of things depending on the type of entity it is and how big they are and if they have employees. What I'll say is we'll ask for those things, and sometimes they send us fraudulent 941 forms or fraudulent tax forms or things that they kind of know that they can send in, and if you don't catch it, it could go through. And so that's what bankers like us are doing, is looking for what doesn't feel right, what doesn't look right. If it's in a form that's clearly been modified, it's things like that. And so that's where we're then denying that loan. And interestingly, you'd think that when we send the denial notice, they would just stop. But I personally have had to reply to emails where they're like, I don't understand. I sent you everything you asked for. And it's like, well, you have to be really careful how you reply. But I have a feeling sometimes if they aren't getting caught then and they do get the loan, that's where the forgiveness issue may come into play. Or it's also, there's rules for those that don't know, there's rules even on if you make easy math, if there's $100 loan from a PPP, you have to use at least 60% of it for payroll expenses. And the whole point of that is so you keep people employed. So if you then submit your forgiveness documentation and you did not have at least 60% of your loan amount used for payroll, it wouldn't be forgiven. It might be partially. I don't know how they'll do that, but the SBA has to decide that. But we didn't want it to be then where people can lay people off and then still get these loans and get it forgiven. The point of it was to keep people employed. So I believe that's the heart of the regulation. Christine, jump in if there's anything else there, but that's what I could see why you wouldn't get forgiven is you didn't follow the rules of what the SBA wanted.
Yeah, that's exactly what I would have said, Melody. Unfortunately, fraudsters are really smart. And so if there is anything that they can circumvent, they will try. And then related to, 60% for payroll, we heard so many times from our bankers that we're hearing from their customers, or even the non-DIs hearing from their customers saying, wait, I can't pay these people to do nothing. Yes, you can. That's the point of the program. That's
just
exactly
like unemployment. Yep.
Yes, exactly. So that, Stacey, I think we are about out of time. Let me turn it back over to you, please.
Great. Thank you so much. So I want to thank you both so much for all the great information. Really appreciate that. And thanks to the audience for their questions as well. Couple things before we wrap up. I just want to again reiterate that for those of you in attendance today, you will be receiving this information later on, and we will also be posting the information in the video out on the Minneapolis Fed's website as well, so others can check it out there after the fact as well. I'll also mention that coming up next week on Tuesday the 13th, we do have the Fed's next installment of the Racism in the Economy series. That will also be taking place from 11 to 2:30 Central Time that day. So please, if you're interested, again, head out to our website and register to attend. Some great information there as well. Also, just lastly, please, just a reminder that you will be given a survey at the end of the call of the meeting today. So we would really love it if you'd prefer us or provide us, some information and some feedback as far as today's session and future sessions are concerned as well. So with that, thank you to everyone and have a great day.
Thanks, everybody. I appreciate it.